so let's go ahead and start. First of all, well, wish everybody a very happy new year, and I do hope that this new year brings lots of prosperity and lots of pips into everyone's accounts. Should be a good trading year ahead for everybody. Thank you, Boyke. Okay, I wanted to kick off the new year, start off the first session of the new year with what I consider to be most important aspect of trading, which is money management. Now, for those of you who have attended my previous webinars, incidentally, my previous webinars, the last 4 or 5 webinars are available as a recording on FX Street itself. You can find the links there. We have covered this topic earlier. We started off with the 3 M's, the money, mind and method, and we have already covered some parts of money management, but I thought it important enough to go over it once again, and I want to very specifically concentrate on 2 aspects of how your capital is related directly to your trading style and your time frames that you choose. Or let's put it the other way around. You do not choose your time frames. Your capital decides your time frames. And this is one thing which a lot of new traders, and for that matter even experienced traders, are not very familiar with this concept. Everything depends on your capital. Let's start off with the most basic thing about the 2 or 3 rules of basic money management and the capitalization. As we said, what is the amount of capital that you require, that you would need to succeed in the forex markets? Not to trade. Anybody can trade. I mean, I can go ahead and trade. I can win, I can lose. It really doesn't matter. What we want is, if you need to be consistently successful and you need to make a living from here, make profits consistently, what is the amount of capital that you should have with you? This is something which I would repeat, which I had earlier mentioned, is that if there was one rule, if somebody asked me to implement in forex today, we have this crackdown due to subsequently to the subprime mortgages and the financial crisis. At least in the US, there's been a lot of crackdown on forex trading. The leverages have been restricted. People are not, US citizens at least, are not allowed to open accounts outside of the US. It's good in a way. Definitely you need the markets to be regulated, which unfortunately the forex market today is still quite unregulated. But if there are some more rules which somebody would ask me, I would say that you should really not allow anybody, any trader, to open an account without the bare minimum. You come across brokers, we have come across brokers saying that open an account with $200 or $300. Sit at home, work in your pajamas, make money 24 hours a day. Well, folks, if you start an account with $300, I can guarantee you, you will not make money. And even if you do, let's put it this way, that the fact of the matter is that even if you do make money, you would probably, let's put it this way, that I would want to make about 5 to 10% a month at the most, which I'm being very, very optimistic about it. The best of the hedge funds would give you about 10 to 12% per annum. I'm saying that 5% a month. Now, if you take $300 and you pay it at 5% a month, you are making a mere $15 a month. Is this what you really want? So your capital really decides on what you want to do. If you want to make a decent $1,000 a month, let's take a very base figure of $1,000 a month, which I think is a decent amount for anybody for a start. You must have a decent amount of capital in you. Look at the returns. Okay, let's get into the basic rules of money management. There are only 2 rules, or let's put it down as 3 rules. The first, of course, is, let me get down to this website. Just give me a moment. Where is my sharing? Alright, can you see this website? Website okay? Okay, alright. We've gone through this before and I want to go over it once again. 2 rules of money management, basic 2 rules. First, your risk to reward ratio should be a minimum 1:2. That means if you're trading and you have an expected, or you put a stop loss of, let's say, 20 points, your expected profits, it's always expected, you can never say that it's going to be a guaranteed profit or a loss for that matter, should be at least 40 points. That's the first and the most important rule. The second important rule is never risk more than 2% of your account at any given time, preferably 1%. I've known traders who risk 25% of their account on one trade. 4 losing trades and your account is wiped out, and getting 4 losing trades in a row, it's not difficult. In fact, it's a pretty common thing. Believe me, I do my trading. We can get 4 losing trades in a row and not think twice about it. That's what trading is all about. You will get losing trades. The third, I wouldn't call it a rule, but it's a very important aspect of trading. Whenever you're trading, you should always trade with multiple lots. The point is, if you trade with one single lot, it does not help you maneuvering your money management positions. Trading with multiple lots enables you to take profits early and still remain in the trade in case the trade goes in your favor. Trade management is a very, very important aspect of trading. Minimum 3 lots is what I would recommend. 2 lots is acceptable. 1 lot is a no-no. So let's take it as 3 lots. Alright, let's take this simple mathematics to understand the importance of money management. For those of you who have seen this before, it's really very interesting. For those of you who have not, well, it kind of opens your eyes. Right now, this is one website. You can see that it's radioactivetrading.com. It's a simulator. So what you have to do is enter your values for the target return. So this is your risk to reward ratio, basically return percentage you get if you win on the trade. So if I say loss limit is 10, so my risk to reward ratio over here is 1:1. So my loss is 10 percentage, sorry, the target return, so expected profit. This is a percentage return. So if my expected profit is 10% and my expected loss is 10%, my risk to reward ratio is 1:1. Profitability of loss, the number 3, is the probability of win-loss ratio. Out of every 10 trades, if you get 5 trades correct and 5 trades wrong, it is 50% is your probability of loss. Right? I would keep it at 60%, because believe me, out of every 10 trades, I would still say that you can get, or we do get, up to 4 losing trades out of every 10 trades. Right, so let's keep it at 60%. Now if we keep the risk to reward ratio 1:1, and I have a win-loss ratio, say with my trading that I'm doing, with the techniques that I'm following, I get 6 correct trades out of every 10. I still do get 4 losing trades, and my starting capital is $10,000. Let's do a simulation. Right, in the simulation, at the end of 100 trades, I am left with, or my total capital is $600, which is not good. I need my account to grow. Let's give it one more simulation. This is random simulations. Now this gives 249 trades. It says bankrupt after 96 trades. Oh boy, that's bankruptcy. Alright, so I lose my capital. Now let's change the basic thing, risk to reward ratio. If my increase my risk to reward ratio, my expected profit is 20%, my loss is 10%, which means my risk to reward ratio is 1:2, which is the bare minimum that I would always recommend. And if I do a simulation, I end up with $35,000, which is a positive. Anything more than $10,000, even if I take 5% of $10,000, 100 trades, well, let's say I take 20 trades in a month, just as a ballpark figure, right? So which means I need 5 months to make 100 trades. At 5 months, if I catch 5% a month, I'm just talking figures today, folks. If I catch 5% a month, that means I expect to make 25%. My $10,000, I should make $12,000 at the end of 100 trades, is what my bare minimum should be. I make $35,000, which is very good. So let's give it one more simulation. I make $62,000. Wow. And one more simulation, $26,000. So bare minimum is still 250%, which is good. So your risk to reward ratio increases your profitability drastically. Now folks, these are just mathematics. These are figures. Does this really depend on what system you're trading? I may be trading the harmonic patterns. I may be trading a divergence. You may be trading a moving average crossover. Does it really matter? These figures matter. So your risk to reward ratio is a very crucial aspect for whatever trading system you're making. You're trading, see to it that your risk to reward ratio is a minimum 1:2. If it is not 1:2, do not take the trade. It's just as simple as that. Pass it on. Now this is what the mind factor is, the discipline of following a trading plan. Right, now let's just increase it a little. If I increase my risk to reward ratio to 1:3, the systems that we follow, that I follow, the harmonics, the divergence, the wolf waves, they do give us a risk to reward ratio of 1:3 quite often. In fact, it's very common. And if I do a simulation, you can see that it goes up to, well, 34,000 and 103,000, and let's give it one more, 449,000. Right, so it increases. So the better your risk to reward ratio, the more it is, better is your profitability. Right, now keeping this into account, let's get down to, let me share the other Excel sheet. Now this is an Excel sheet which we went over last time. A lot of folks asked for this Excel sheet. I did send it across to a lot of people. Let's come back to your position sizing. Right, we went over risk to reward ratio. Do not risk more than 2% of your account at any given time. Let's get on to the capital. Let's talk about mini accounts. I trade my mini accounts even though I may have $6,000 to $7,000 in my account. I prefer trading a mini account. Now this is formulas, mathematical formulas. It's not mine. You do a search on the net, you'll come across this. Professional traders follow this. The position size for a mini account is E is your equity divided by the figure 500 into bracket -1, which simply means that if I've just fed this into it, that if my account equity, if I start my account with $3,000, I can trade a max of 5 mini lots. Right, let's say that I started an account with $2,000, and I've just fed this formula over here. $2,000, I can trade a minimum of 3 lots at any given time. Now once I said that we go ahead with multiple lots, 3 lots is what I have, so which means that if I have $2,000 in my account, I can take one trade at a time of 3 lots. Until the time the trade is not closed for a win or a loss, I cannot take another trade, because that's what the figures are saying. Now let's take the example of, let's say somebody starts an account with $300, right? This is what the brokers tell you. Open an account with $300 minus 0.4. Mathematically, you should not even think about taking any position when you have $300 in your account. Let's say if I have $1,000 in my account, 1 mini lot, not recommended again. Bare minimum, you can go ahead, okay, you have $1,000, trade 1 mini lot. Once again, it puts you at a disadvantage because you're trading with 1 lot. So what is the minimum amount of capital required, which is the topic that we are discussing? For a mini account, folks, believe me, I would recommend $3,000. Minimum $3,000. If you do not have $3,000 to open an account, my recommendation would be wait till you gather that capital and then open that capital, because if you are going to open an account with about $1,000 or $500, believe me, you will give it away to the market. It's a write-off. I may sound very crude about it, but this is a fact. I've seen it in a lot of traders. So instead of wasting that money, you might as well put it somewhere else or save it up, or go ahead with some kind of a course which will improve your efficiency, improve your trading a little bit. Or for that matter, if you do have a small capital, trade micro accounts. You have micro accounts. A lot of brokers give you micro accounts today. With $500 in a micro account, you can trade 4 micro lots. So your rules of money management, they are followed, but then there's a disadvantage. Let's say, for example, you're in a trade which is giving an expected profit of, let's say, 50 pips. On a mini account, you would have made $50 on a mini account, right? Because 1 pip is equivalent to $1. On a micro account, you will make only $5 of profit if you put it down in terms of money, not pips. So if you're trading on a 50 pip move and you're waiting for that, and you come out at the end of the trade with only $5 in hand, it frustrates you. It does. I mean, let's be practical about it, right? I'm not sitting here for 4 hours in front of my computer and I come out with only $5 in my account. I mean, what the hell? What am I doing this for? No, I need $50 in my account for a trade. So then what you do if you're trading micro lots and you have only a little bit of a capital, you start bending the rules. And you say, oh, this trade looks good. Doesn't matter. I mean, I know Sunil said that. I mean, he's right in his own way, but this looks like such a good trade. I'm sure I'll make money out of this. So you increase your capital exposure, right? Instead of mini lots, instead of the one mini lot that you would ideally trade, you go ahead and trade with 3 mini lots. And what you're doing, you're increasing the exposure. Now let's get down to the charts. Let's correlate all of this to the charts. Let me share my charts right now. All right. Baki, could you repeat that before you say 2%? What was the question? All right, charts okay? Can you see the charts? Could you just confirm, please? The number one on that simulation trade web site was your expected profitability. So risk to reward ratio, that was your reward. Or were you asking about your rules of money management? Risk to reward ratio working. 2% is rule number 2, never risk more than 2%. Rule number 1 is your risk to reward ratio should be a minimum of 1:2. Alright, now let's take this particular example. Right, we are correlating everything onto the charts. Let's go ahead with the 5-minute chart. I had a 5-minute chart over here. Oops. There you go. Alright. Alright. Now let's say that I open an account with, I have $500 with me. Let's say I have $1,000. As per the Excel sheet, I can trade only one mini lot. I'm trading mini lots. I don't want to trade micro lots, because if I have an expected move of say 25 pips, in a mini lot I'll make $25. In a micro account I'll make $2.5, which I don't want. Right, so let's say I'm trading on a 5-minute time frame. Let's take, for example, now let's take this as a divergence. Let me just put this. Right, for those of you who are familiar with divergence on a 5-minute time frame, this is a divergence, right, where you can see, let's just zoom this inside a little bit, where price makes a high and a higher high, right, and your stochastics, any oscillator makes high and a lower high. This is a classical example of a bearish divergence, so you expect price to reverse towards the downside. And I said that, okay, this looks good now, this is a good divergence, this is a good setup, and I can enter in a pretty nice trade. Now I have only $1,000 in my account. I'm supposed to trade with only one lot, but with one lot I follow my rules of money management, saying that I will not exceed more than 2% of my account. Right, now 2% of my account on a $1,000, how much is 2% on 1,000? It is $20. So which means if I'm trading on a 5-minute time frame, my stop loss cannot be more than $20, 20 points if I'm trading on a mini account. Let's say that I always keep my stop above the previous high, where price reversed from, just above the high. And let's assume that I entered the trade somewhere over here. Why am I taking this? Because this is a good level of support resistance. Right? Can you see this? Just simply looking at price found resistance over here, then found support, and then found support subsequently, of course. So I'm just choosing this. This ideally should be your entry. Let's say my target is somewhere down over here. Let's take another good support resistance level. I'm just taking it randomly, so the resistance turn support is expected to move down, so I would say it moves down. Risk to reward ratio, first let's come across 1:2. It definitely is, right? So I have a stop at 1.0511. My entry is at 0.506, which is just about 5 points of stop. Expected profit is 0.489, which is about 17 points. So risk to reward ratio is definitely more than 1:2. How do you enter in divergence trades? Sanjay, you'll have to pay me for that. I'm just kidding, folks. A divergence, the techniques that we have, they are very, very precise. To be quite frank, I cannot just go over this and say that, okay, this is where you enter and this is where you exit and this is where you put your stops. because this is part of the courses. For that matter, I'll just discuss this. We are having the next London workshop where divergence as a technique is a topic of the workshop. It's one of the most effective trading systems. I have taken divergence to the next level, where only if these conditions fulfill, if I use this, I enter the trade and my risk to reward ratio is good, the possibility of success is very, very high. Right? So it's part of a course, and today we are just talking about money management. Risk to reward ratio is very good. Now let's get on to the second one. 2% of my account, right? If I have $1,000 in my account, 2% is $20. If I'm trading with 3 lots, my stop over here is 5 points. 3 lots into 5 points is 15 points. So my risk to reward ratio is also, my 2% of capital is also justified. I am risking $15 onto this trade, which fits in within 2% of my $1,000. Practically speaking, I would never keep a stop loss of only 2 points because it's a little too less. You need a minimum of 10 to 15 points. But this is what it is. Now folks, look at it this way. If I have $1,000 and I see a trade on a 5-minute time frame, it's only one trade that I can take, right? 5 points of stop loss into 3 lots, 15 points. It just about fulfills 2% of my trading capital, which is 20 points. Risk to reward ratio is good. So looking at it from the other way around, if I have $1,000 in my account, I can only trade on a 5-minute time frame. Get the importance of this point, folks. I cannot trade on higher term time frames. And let's go ahead and look at this. We have a very nice 1, 2, 3 pattern currently on the Canadian dollar USD CAD on the 4 hours. Right? We went over, for those of you who have attended my previous webinars, what is the best confirmation of a 1, 2, 3 pattern is where we use fans. If price stops exactly at the 88.6 fan level, it is a very strong confirmation that this is a valid bullish 1, 2, 3 pattern. We still need a confirmation to enter the trade. Now somebody will again ask that where do you enter the 1, 2, 3? Again, this is a trading system, so you need a stronger confirmation, but this is a 1, 2, 3 setup. Doesn't necessarily mean you enter a trade right now. But let me just take an example. Let's say that I'm taking an entry. I'm just keeping things very, very simple. This looks like a good level for me, for the simple reason this is the previous resistance which turned into support. Price action tells you a lot of things, folks. It really tells you a lot of things. If you do not look only for added indicators and look just at price, it gives you enough of clues. So I would probably want to place my entry over here. You see what happened when price bounced at the 88.6 fan level? It went up, it yo-yoed up and down, gone into a consolidation, but did not break this particular level, which is a level of resistance turns support. Now these levels we call as zones, supply and demand zones. Any level which is resistance turns support or support turns resistance becomes a very strong zone. So I would probably enter the trade only if price breaks this zone convincingly, which is a very strong indication that if this zone has been ruptured or broken, then price has a good possibility of moving up. So I would keep my entry over here. Where would I keep my stop? I would keep my stop below the lowest low, little below the lowest low. Right? Let's forget about the profit for the time being. Let's just concentrate on the risk. Your profits, for those of you who remember, Fibonacci expansions are used to determine the profits, and your Fib expansion 100 is the most likely place. Let's just plot this. If I take this Fib expansion, this is my expected profit. Right? On a 1, 2, 3 pattern, your FP 100 is the most likely place where price would go. Risk to reward ratio, definitely good. You can see it over here. It's definitely more than 1:1. In fact, it's about 1:3, little more than 1:3, which is very good. Now let's come down to your capital. Let's say I have only $1,000 in my account and I want to trade this. It looks very nice. What is my risk? My entry is at 0.9871 and my stop is at 98.32. Let's make it round at 40 points. 98.70 to 98.30. So 40 points is my stop. Piece of advice, folks, never ever play around with your stop loss levels. If this is where your stop is supposed to be, this is where it should be. You cannot change it saying that, okay, I can't risk it or I can't afford it. So if I have 40 points and I'm trading 3 lots, which means I'm trading, my risk is 120 points. Now, what percentage is 120 on 1000? 12%? Where is my rule number 2? Do not risk more than 2% of your account. It goes for a toss completely. I am risking 12% of my account. Believe me, folks, do not ever do that. 5 or 6 losing trades in your row and you are out of the game. You're finished, and you can get 6 losing trades in a row. It happens. Now, the other point is never play around with the stops. I cannot say that, oh, I can't afford it. So what I'm going to do is I'm going to keep my stop over here. It's not a technical stop, folks. It's a comfort value stops is what I call it. Is you are risking because you cannot afford it. So you're saying that I'm comfortable with this stop. The markets do not respect that. The price does not respect that. Your stops have to be down over there. So if I want to trade on a 4 hours, what is the capital that I require? 120. How much, what percentage of my capital do I require at 120? If I have $5,000, 2% of $5,000 is 100, which still does not fit into it, which means I require about $6,000. So the higher the time frame that I want to trade, which it's better if you trade on a higher term time frame, larger is the capital that you require. So if I want to trade on the 4 hours, I need at least $6,000. And if I want to trade on the 5 minutes, $1,000 is sufficient for me. Now let's talk about the profitability. When I said that you should have a minimum of $3,000, let's say that I have $3,000 and we'll come back to the 5-minute time frame. Right? This is what I was looking at a bearish trade for. This fits into my, let me just put out the stop a little more, because I don't like keeping a stop of only 5 points. I would stretch it a little more to keep it, let's say, about 10 points. My expected profit over here is a good 15 points. So if I'm trading 3 lots on a mini account, 15 points into 3 lots, assuming that I stay in the trade for all 3 lots, which we don't usually, but let's take just some ballpark figures. I make $45 out of this trade, which is justified. On a 5-minute time frame, this trade will probably get over in a couple of hours. If in a couple of hours, if it goes in my favor and I make $45, which is very good. How much is $45 of 3,000? What is your percentage of 3,000? Right? What is the percentage, folks? Come on. 5%? Roughly? No. 3 5 is 15. It's a little more than 5%. What is the profit percentage that you are making? You are making a decent amount of profits. Now, everything, folks, depends on your money management. It's about 2% roughly, 1.5%. So on one trade on a $3,000 account, you've made 1.5% profit. If you do this once a day, let's say you do get a trade once a day, you make 1.5% profit a day. In a month, your account will grow. And the point I'm trying to make over here is follow the rules of money management. Keep into account that the more capital you have, better it is for you. No, Suleiman, we enter all the lots at the same place. If I'm entering this particular trade, I will enter the trade with 3 lots. We don't add on to the positions later. No, this is a very, very personal thing. I have some of my traders in my room who do not agree with this, because in this case what happens is your risk is the maximum when you're entering the trade. Right? In case the trade goes wrong, I lose 3 lots of my stop level, which is a large risk. But for me, it's acceptable, because if the trade goes in my favor, I can keep taking out my profits and still remain in the trade. As against, let's discuss this. Is a very interesting situation, interesting question. A lot of folks have different approaches to it. Now, you have to decide your approach to it. There's no fixed, hard and fast rule for it. if I enter, let's say this trade looks good. Let's take into example this Canadian dollar on the 4 hour. But it's looking good. Let's say price does move and reaches the level of 0.9870 that I was looking for, and I enter the trade. My setup conditions are good, my risk to reward ratio is good, my position sizing is good, so it should be a good trade. Should I enter with 3 lots here, or should I enter with 1 lot, and when price starts moving up in my favor, should I add more lots? That becomes a very important point. For me, I would enter the trade with 3 lots. Because as soon as price starts going in my favor at certain levels, I try to take out my profits and shift my stop to my entry level, which is my break-even level. So you see what happens at that stage. At a certain stage, we are in a free trade. You've already locked in some profits. Your stop loss is moved to your entry. Your risk is absolutely zero. If price turns against you for some reason, you have walked away from the trade with no loss and a little bit of profit. But if I enter with just 1 lot and I start stacking up my trades after that, I cannot do this. You see, instead of trying to take out profits from the market, I am just adding to my positions. I'm just giving you my perspective about it. As I said, it's a very personal thing. I have some of my own traders, as I said, traders in my room who have taken courses with me, who are doing well, but they do not agree with my principle and they follow their own principle. It's a very individualistic approach, entirely depends on you. Anyway, important point was what I wanted to discuss today again was your capital determines the time frame that you will be trading on, determines the profitability that you want from the market. Let's say that I expect to be very, very reasonable and optimistic, that I expect about 5% a month from my account, which is very much achievable. It's not difficult, believe me. Now, correlate that with the amount you want, not percentage, amount you want. Let's say that for me, $1,000 is okay, that I need $1,000 a month, that I decide that I want to make $1,000 from here. Some people might want $5,000, some people might want $10,000. I'm just taking a ballpark figure. Now, if I can make 5% a month, the reason why I'm putting it 5% is because what we've been making, and it's not difficult. So which means that if I need to make 5%, which relates to $1,000, what is the capital that I must have? Right? If I have $10,000 with me, let's assume that I have $10,000 with me. What is 5% of $10,000? It is $500. Which means I need $20,000 of capital to make $1,000 a month. And then if I have $20,000 of capital, I can comfortably trade on a 4-hour trading chart frame. I can comfortably trade even on maybe on a daily time frame, because my risk to reward ratios and my money management fits into it. This is what I want to really emphasize upon. There are a lot of folks who want to start off with $1,000, $2,000, and they expect to make $2,000 to $5,000 a month. That means what you're expecting is you're expecting to make 100% profit per month. Why do you want to do that? What hedge fund or what institutional fund gives you a return of 100% in a month? Tell me. Anybody knows about it? Tell me. I'll put my money over there. All the money that I have in my Swiss bank account, I'll put it over there. Get realistic, folks. That's everything depends on the capital and your expectations of profit. Keep a ballpark figure. Now, I'm really being very optimistic, but as I said, it's achievable. 5% a month can be achieved. I would say 2 to 3% a month is what you should expect from your trading. Folks come into this business and say that I will make 100% in a month. And I keep saying this, buy a Ferrari at the end of the year. You can't do that. You will get blown away before you even realize. So your expectations, that it creates a psychological effect on you. When you have such high expectations from the market and the markets do not give you, which they will not, you get frustrated. You start bending the rules. So this is a place, folks, where most of the traders tend to lose money. When you come into this business, be well prepared. And being well prepared is also having the correct expectations from the market. Your capital determines everything. The profit that you want to make, the time frame that you will trade upon, your money management, your style of trading. Now, when I say style of trading, I wouldn't want to go in for scalping if I start trading, if I'm trading with only $500, right? Because even on a smaller term time frame, my stop loss is not justified. All right, I think that's about it. That's what I wanted to emphasize upon, is your capital determines everything. Put these factors into consideration before you start live trading. Whatever trading system you may be following, it really doesn't matter. See to it that your money management principles are in place and you have realistic expectations from the market, which is determined by your capital. Raise that capital, wait for some time, save up your money, start off with the correct capital, because if you start off with the wrong amount, you will only blow it away. And believe me, you will do it. It's not easy to survive in this. It's not difficult either, but you have to go about it in the correct way. Alright folks, so I think that was the most important point which I wanted to discuss, that your capital determines everything. So think about all these things before you start trading live, or if you're already trading live, try to implement these principles into your trading. Alright folks, that's about it, and good to be over here once again. If you have any questions, please feel free, let me know. It'll be good. Well, you're welcome folks, and for that matter now no, okay, I don't have a new cat now. We've moved on from the cats, we shifted house, so now we've got 2 dogs. Cats and dogs don't get along, so the cats are out right now. After I lost that one, we never got a new cat. I will not be available the next week, next Thursday, because we have a webinar. Let me just put this. My new institute in London School of Financial Trading, we have a free webinar next week. I will be sending out the link to everybody over here. Feel free to attend. It's next Thursday, of course it's a little later, but I'll be preparing for that. So again, we'll be discussing part of this. Principles, the right way to trade and be a successful trader. And of course, my London workshop coming on 16th and 17th Feb, discussing some parts of the London workshop or what we are going to go through. So I'll be sending out a link to the free webinar. Feel free to attend. It'll be good to see you folks at the free webinar. It's 10th of Jan. It is at 8 p.m. GMT, so which is a little late. Right, and I'll see you folks then the Thursday after that. That is the 17th Jan here on FX Street. Till then, have a nice trading week and a good weekend, and once again hope you have a great new year ahead. So I'll see you folks later. Thank you very much for being over here. Always a pleasure to talk to you folks. If you have any questions, feel free to let me know. I'll talk to you folks later. Thank you.